Welcome to Deloitte's Debriefs Tax webcast series in Asia Pacific. Our webcast today is from our Indirect Tax series entitled Gst Considerations for Inbound Investors into Australia and Updates on Stamp Duty, Property Taxes and Customs Issues. My name is David Ware and I am a tax partner based in the Deloitte Australia Melbourne office. I have the pleasure of hosting today's webcast. I have two speakers with me today, Frank Ailes and Nicholas Clifton. Frank is a tax director also based in our Melbourne office. Frank specialises in GST and has worked both in the UK and in Australia. Nicholas is a tax partner who is also based in our Melbourne office. Nicholas leads Deloitte's Victoria State Taxes team, specialising in stamp duty. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximise or minimise each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Now, please let me give you an overview of the topics we will discuss. Our presentation will start with Frank presenting on GST considerations for inbound investors into Australia. Frank will then hand over to Nicholas, who will provide a stamp duty property taxes update. I'll then provide an overview of the latest Australian customs issues and opportunities. We'll then have time at the end for questions and answers, and I would encourage you to type any questions you have into the box throughout the presentation. So without further ado, I'll hand over to Frank to discuss GST considerations for inbound investors into Australia. Frank.
Thanks, David. So when acquiring an entity or a business in Australia, there are a number of relevant GST considerations in that process. And I'm going to discuss today some of the particular GST rules that Australia has relevant to the M&A process, including in relation to recovery of GST on your transaction costs when acquiring a company, use of what's known as the borrowing concession, and finally the use of indirect tax sharing agreements when acquiring an entity that's a member of a GST group. So we go to the next slide. So we wanted to first start with a polling question. So the question is, has your business invested into Australia in the past year? And you can choose from one of the 5 options up on the screen in front of you there. So we'll give you a minute or two just to consider that question and provide an answer.
So, Frank, while we're just waiting for the results to come in, what have been your observations of M&A activity in Australia over the past year, given the impacts of COVID?
So, as you expect, we saw with our clients a significant decrease in the period starting from April last year. So we saw a reduced activity for a period from April onwards to probably June, July, August, when M&A activity started to see a pickup in Australia. And with our clients, it seemed to ramp up towards the end of last year, and this year so far we've seen a lot of M&A activity today in the market. So. Okay, so we've got the results through there. Interesting, fairly evenly mixed results. So we've got a number of you that have purchased either an entity or a business in Australia over the past year. Interestingly, about 50-50, whether it's a business or an entity, and then we've got about 30% who may do so in the future. Okay, so a fairly even split there. Okay, so if we move on to the next slide. So the first topic I'll discuss is GST on transaction costs. So dealings in shares and units, or borrowing and lending, are what's known as input taxed financial supplies in Australia. So this is a similar treatment to what's termed exempt in certain other GST or VAT regimes. So what this means is those transactions don't give rise to a GST liability, so there's no GST applying to the sale of shares or the sale of units. But where you incur costs relating to that acquisition or that sale, you can't necessarily claim back any credits for that GST unless a concession or a special rule applies allowing you to claim those credits. So typically when a M&A transaction occurs, the transaction costs will include legal, accountancy, due diligence, investment banking fees. And all of those costs are seen under Australian GST provisions as relating to that input tax financial supply of the acquisition of the shares or the units. So the question is, where you incur those transaction costs with GST, how can some or all of that input GST on those costs be recovered? So if we move to the next slide. So first consideration is whether there are actually non-resident counterparties involved, because in this case, the transaction may actually qualify as GST-free rather than as input tax. So the GST-free status overrides the input tax status. And what this means is if either the seller or the buyer is a non-resident entity, so not an Australian entity, that transaction becomes GST-free, and full credits are then available for any GST incurred on those transaction costs. Just one thing to keep in mind in this scenario is that where you've got a non-resident party, although there may be no Australian GST considerations, there may be GST or VAT implications in the local country of that entity. So if this is not the case, so if both the seller and the purchaser are Australian entities, what that means is the transaction is input taxed. So full credits may not be available, but the next consideration is then whether the acquiring entity will breach what's known as the financial acquisitions threshold, or the FAT. So the FAT is a de minimis test we have in Australia, which is designed to simplify the GST system for taxpayers that generally operate fully taxable businesses, but may also make some input tax supplies which are outside the ordinary course of their normal business operations. So we go to the next slide. So the FAT will not be breached, provided that GST paid on costs incurred relating to input tax supplies, so your transaction costs. On all of your costs.
Okay, I think we've just lost Frank temporarily. Hopefully he'll be back in 1 second. But in the meantime, Nicholas, perhaps you might move to the stamp duty content of the presentation. Unless Frank is within a split second here. Okay.
Excellent. Well, why don't we advance the slides to the stamp duty section?
So, yep, from slide 16.
Excellent. So stamp duty in Australia is a state-based tax. Each of the states and territories have their own regime for the imposition of stamp duty, as well as land tax and other property taxes. You'll see there a stylised map of Australia. The main states are obviously New South Wales, Victoria, Queensland and Western Australia. Each state and territory imposes stamp duty on the purchase of property, and that's typically at rates between 4.5% to 5.95%. That stamp duty also applies to the purchase of businesses where there's customers in Queensland, Northern Territory, Western Australia. And in all states and territories, the same duty applies to the purchase of entities that have substantial land assets. You'll also see on the diagram in front of you that there are surcharges for residential stamp duty on purchase. So these hit foreign purchases of residential property, and it imposes up to an extra 8% stamp duty on the purchase of residential land or land for development. The worst scenario is probably Victoria and New South Wales, where you can end up with a 13.5% stamp duty applicable. Each state and territory also has a base land tax, and you'll see that in the map. The base land tax does vary considerably based upon property values. Maximum rates are 2.25%, 2%, 2.75%, that type of rate. However, there are additional surcharges for foreign-owned property, and that's a 2% land tax in Victoria, New South Wales and Queensland. Queensland and Victoria actually impose that on all commercial and residential property, whereas New South Wales only imposes that surcharge on residential property. We'll go to the next slide. So as we said, duty in Australia is payable on the purchase of land and buildings in all states and territories, payable on the purchase of business assets, but only in some of the states, purchase of companies and unit trusts with underlying land assets, and each state and territory has the different rules. We'll go on to the next slide. One key area that we thought we'd raise with you today is the new New South Wales property tax reform package. This was announced late last year and is still in draft form, with subject to a lot of consultation. Current position in New South Wales is that if you buy land and buildings, you pay 5.5% stamp duty on purchase. That's a one-off on the market value of the land and buildings. Whereas going forward, you'll always pay a 2% land tax on the statutory value of the land, and that's the base land value excluding buildings. That's the current position. It's proposed that purchasers of property will have a choice to opt into the new regime at the point in purchase of a property. Under the new regime, if they choose to opt in, there'll be no stamp duty payable upfront, so you save 5.5% of the purchase price for the land and buildings. But there'll be an annual land tax, which will consist of the current existing up to 2% land tax on the statutory value of the land, plus an additional amount, and that additional amount will vary between different property types. So for an owner-occupier, that might be at best a 0.3% statutory value of land plus a $500 base. Farmland, it might be a simple 0.3%, but for commercial property, which I assume most of you would be interested in, it will be a 2.6% surcharge on top of the statutory value of land. That would mean that instead of paying 5.5% on the developed land up front, you'll end up choosing to pay 2.6% for the life of your ownership of the property, but only on the statutory unimproved land value. We see that this would be a very worthwhile choice for residential property purchases. Property purchases for residential land will save a lot of money up front because they won't have to pay the 5.5%. Instead, will just pay a very small property tax. For commercial property owners, they'll have a more interesting choice to make. While it'll be a fairly simple exercise to calculate what it would be once you know your property, you'll have to choose between paying 5.5% once off upfront on the land and buildings, or paying a 2.6% statutory surcharge each year, but only on the underlying land value. If you're buying land, say an office tower in the city, that's the type of trade-off that you'll probably do quite easily because the bulk of your value will be in the buildings, not in the unimproved land value. Whereas if you're buying, let's say, a broad-acre warehouse site, it might be a bit more close in terms of land value and building. We'll go to the next slide, thanks. So the final details are to be determined, but we expect that properties in the top 5% of commercial property values or top 20% of residential values probably will not be able to opt into the system. First home incentives would be replaced with a $25,000 grant. That'll be quite useful and it's intended to stimulate the furniture and other industries retail industries in Australia because you'll have a large sum of money that you could either pay for stamp duty or choose to pay on furnishing your property. As I said, once we know the final thresholds and rates, it should be an easy exercise to the model choice for a buyer based on expected holding time frame. We'd expect, say, private equity with a shorter time frame would be very keen on choosing to opt in. There'll also be a window to opt in properties that are bought before the start date and request a refund of the duty paid. That's intended to prevent any impact on the market where people are choosing not to do transactions because they're waiting for the property tax to come in. This way you'll be able to apply for a refund of the stamp duty and choose to opt in, albeit retrospectively. So we'll go to the next slide. So the question that we've got, just as a polling question, would be, if you could save the 5.5% stamp duty on purchase and replace with a long-term property tax, would you be more likely to invest in property in New South Wales? Would you see no change, but you'd choose not to pay the stamp duty? Or would you prefer to pay the 5.5% upfront and have a lower long-term property tax? And last choice, obviously, is don't know.
Okay. Well, while we're waiting for the results to come in, Nick, what about residential surcharge stamp duty? Will the new property tax replace that as well?
Good question. We don't actually know the answer to that. So that's part of the consultation process at the moment. There's two thoughts to it. One is that they'll put on an extra residential surcharge component to the property tax and allow you to opt in. Or the alternative is that a residential buyer from overseas may still have to pay the surcharge amount, but will be able to choose to opt in the base 5.5% property tax.
Okay, so hopefully the results are coming through.
Excellent. So there seems to be a lot of support for the no change, but would choose to not pay the stamp duty if you could. That's good to know. We've seen that as well from a lot of buyers are actually quite excited and interested in moving ahead. Although there's very strong support also for the would prefer to pay the stamp duty upfront and have a lower long-term property tax. And we think also that will be quite consistent with a lot of investors' profiles. In practice, what will happen is that anytime you're looking at purchasing a property, you'll need to sit down, make the simple calculation to work out whether it's in your interest to move forward or not. And that's certainly something that we can help through Deloitte. Thank you. I'll pass back to Frank now.
Thanks, Nicholas, and apologies for the technical issues there. I'll try to pick up from where I left off in terms of the financial acquisitions threshold. So we're saying that broadly two thresholds, which are your GST on your costs relating to financial suppliers being below both $150,000 and also below 10% of your total GST on all of your costs. So provided you're below both of those levels, the FAT is not breached and you can claim full credits. This applies on a rolling 12-month basis, this test, so you have to look back at costs incurred in the previous 12 months as well as expected costs in the next 12 months. So if you've just made an acquisition and you then have another acquisition that is expected to occur in 6 months' time, then you also have to think about what costs you're expecting to incur for the second acquisition as well as the current one. And another point is that where an entity is part of a GST group, these thresholds apply to the group as a whole rather than to any individual entity. And it's important to consider this when an acquisition occurs, because if you're part of a GST group, you may obviously have more costs than as a standalone entity. So it may be that forming a GST group, say with between the entity that's making the acquisition and the entity you're buying, that you increase those thresholds, and that actually means that you don't then breach the FAT and you can claim back full credits on those acquisition costs. And just a final consideration is that the FAT takes into account all input tax supplies you've made, so that includes both transaction costs and any other financial supplies. So commonly, even if you're normally a fully taxable business, you may have things such as an employee share scheme. So those costs have to be taken into account as well, and certain borrowing costs as well can count towards the FAT. So you need to keep those things in mind as well. Okay, if we go to the next slide. So if the FAT is breached, that means you generally can't claim full credits for that GST, but you may still be able to claim some level of GST recovery. And this can happen in one of two ways. So firstly, what we'd always recommend is to consider whether you've incurred any costs in a really early stage of the process, whereby the costs are far enough removed. So, for example, costs incurred before it's known, say, what form the transaction is going to take. Those may be sufficiently far removed that they're not seen as transaction costs, and they're seen more as ordinary business costs, and you can still claim full credits. And the second point is that certain costs may be eligible for what are known as reduced input tax credits, or RITCs. So under Australian GST rules, you can have costs which relate solely to input tax financial supplies, but they can still be eligible for a partial GST credit. So in most cases, the RITC is 75% of the GST amount, so you claim 75% recovery. There are also some cases where the RITC is 55% of the GST amount, so a 55% recovery. And eligibility for this depends on the type of cost, so what service you're acquiring, basically. So if we go to the next slide. So this slide shows some common acquisitions that can be eligible for these RITCs. So in the context of M&A activity, a key one to be aware of is any sort of investment banking type services that you acquire. So these can fall under the heading there for securities transaction services or asset-based finance services. So where you're paying someone a fee to help arrange the transaction, that's something that can be eligible for the 75% RITC. So that should always be reviewed. Other costs in the M&A process normally aren't eligible for RITC. So your legal costs, your accountancy and DD costs generally aren't eligible for these 75% or 55% credits. So if we go to the next slide. So the other consideration I'll discuss next is what's known as the borrowing concession. So under Australian GST rules, as I said, the borrowing of money as well as lending of money is considered to be a financial supply. And what this means is that in some situations where you incur costs relating to your borrowing, so if you have borrow a range of fees or legal fees, you may not actually be able to claim credits for that GST on those fees, which can be material in some cases. So where borrowing occurs, it can be possible to use this borrowing concession, which sets out that credits can still be claimed in full, provided that the borrowing is used for making of taxable supplies, rather than making more input taxed financial supplies. So this means that if you've got a fully taxable business and you engage in borrowing to fund your business activities, you're still able to claim back your full credits for your borrowing, and you don't have to consider the financial acquisitions threshold. So with M&A and investment structures, you often have a finance company which will borrow externally to fund the acquisition and will then on-lend that money to another group entity for the purchase of business assets. And where that occurs, the finance company can actually find that it can't claim back any credits because it's borrowed money, but it's on-lent that money to another entity. So it's borrowed it for the purpose of on-lending rather than for the purpose of taxable business activity. So in this sort of scenario, it's really important to consider the option of GST grouping. So if the finance co and the entity that's potentially making a business or an asset acquisition can be placed in a GST group together, what that means is the on-lending between those two entities is ignored from a GST perspective, and it's seen as though the borrowing is used for the taxable business activities, and under the borrowing concession you can still claim back full credits. So really important to consider that before the on-lending actually occurs. So if we go to the next slide. So the final topic I'll discuss with you today is in relation to indirect tax sharing agreements. So when you're acquiring an entity that's a member of a GST group, that entity is jointly and severally liable for GST debts of the GST group as a whole, so including all of the GST group members. So if that GST group has a debt that's unpaid, the ATO can actually choose to pursue any group member, whether it relates to whether the GST debt relates to that group member or whether it relates to another member of the GST group. So what this means is a GST exposure can arise if you're acquiring an entity post-completion relating to another member of the GST group. And that's an exposure that can't be identified through due diligence of the entity that you're actually acquiring. So you can potentially be taking on a completely unknown risk when acquiring from a GST group. So Australian GST provisions allow this risk to be managed through the use of indirect tax sharing agreements, which are known as ITSAs. So an ITSA is basically an agreement between all of the members of a GST group, and it sets out a methodology for calculating a fair and reasonable contribution payment for each group member to make towards the overall group liability. So each member calculates its contribution payment towards the total GST debt based on the principles set out in the ITSA. And where an ITSA is in place, GST law allows an exiting member to obtain a clear exit from the GST group, whereby its liability is limited to its own activities. So this means that you can then acquire an entity within a GST group and have some comfort that you won't then have an exposure relating to other members of that group. So when acquiring an entity that is a GST group member, there are a few points that it's really important to confirm during that process. So firstly, is there a valid ITSA in place? So does the ITSA, has an ITSA been drafted, and does that ITSA meet all the requirements the ATO expects an ITSA to have? Secondly, if an ITSA is in place, does that ITSA cover all open tax periods? So if it's recently been entered into, there may be historic periods that are not actually covered by the ITSA where an exposure could arise. And finally, does the sale agreement require the target entity to follow all necessary steps to obtain a clear exit? So in order to obtain a clear exit, you normally need to ensure that the exiting member, so the entity that you're acquiring, does things such as makes an exit payment to the group representative and calculates that exit payment in accordance with the principles in the ITSA. So it's important to assure that the sale agreement places that obligation on the vendor to ensure that a clear exit is achieved. Okay, and with that, I will pass now on to David for the customs updates.
Great, thank you, Frank. So today I'll be covering some Australian customs and global trade developments. Firstly, I would like to cover a customs case that made it all the way to the High Court in 2020, the Pharmacare case. So for those not familiar with the Australian judicial system, the High Court is the highest court in Australia, and it is quite rare for a customs case to make it to this court. This was a tariff classification case involving Vita gummies and weight loss gummies designed for children. The question was whether these products were medicaments or food. So the analysis centred on the meaning of a particular chapter note in the tariff and the meaning of words in that chapter note. So as part of the arguments put by Customs, they referred to the French version of the tariff and the tariff notes and said that that was equally authentic with the English version and therefore admissible to construe the meaning of the English version language. So relevantly, certain words in this note appear in the English version and not in the French version. And this led to reference to the Vienna Convention on where the English and French versions cannot be reconciled. In these cases, the meaning which best reconciles the text having regard to the object and purpose of the treaty shall be adopted. So the High Court agreed with Customs, stating that a meaning that gives simultaneous effect to all the terms of the English text and of the French text must be preferred to a meaning that does not. So this conclusion led to an interpretation of the note that could not be reached by reading the English version alone. So this now means that tariff classification in Australia has an added level of difficulty and uncertainty, as there is a need to consider the French version of the tariff, and if there's a difference between the English and French versions, to determine a meaning that gives simultaneous effect to the terms of the English and French texts. So as you can imagine, this result causes a lot of uncertainty in determining tariff classifications, and now technically requires a classifier to be able to interpret the French version as well, which seems absurd and well outside the capability of a customs broker. In fact, only 0.6% of the Australian population are actually fluent in French. So ironically, in this case, Customs was actually not successful. The Vita gummies were determined to be medicaments and are duty-free. The High Court identified errors taken in the approach to tariff classification in the Federal Court and the Administrative Appeals Tribunal, although this did not ultimately change the outcome. But what's happened since the case is the government has actually passed legislation to add some additional notes to the tariff to effectively reverse the decision, such that these products would now be classified as food and subject to customs duty. We also understand that Customs is not expecting customs brokers to refer to the French version when classifying goods, but has said that if there's uncertainty or controversy as to the tariff classification, it should be referred to. So the question obviously then is, how would a customs broker or someone classifying goods know what Customs considers to be controversial or uncertain tariff classification? So we're yet to see any written guidance from Customs on their position in these matters. There's also another recent case, the Smooth Flow case, in which they referred to the High Court decision and once again considered the French version of the notes. So the message is that there is now more uncertainty than ever with tariff classification in Australia, and any classification is open to challenge by reference to the French and English versions of the tariff. So just changing tack off that topic, there has been some progress made with some free trade agreements. So Australia is very active in this space, currently having free trade agreements in place with 20 countries, some bilateral and others multilateral. Many of them overlap, where an importer or exporter can utilise whichever agreement they choose. Australia's largest free trade agreements in terms of trade volume and value are with the US and China. So Australia also signed the Regional Comprehensive Economic Partnership, RCEP, late last year. And while it brings a number of benefits, Australia, in fact, already had a free trade agreement in place with all of the other 14 countries who signed RCEP. And RCEP is now subject to the ratification process in the countries that signed. Other updates, negotiations continue with the European Union, with the 10th round occurring in March. This free trade agreement is still a fair way off being concluded, as there are a number of important areas where agreement has not yet been reached. A free trade agreement with the UK, on the other hand, seems to have overtaken the EU FTA in terms of expected conclusion, and is likely to be signed this year as both countries are moving quickly, and weekly calls are occurring between the trade ministers in each country to progress negotiations as quickly as possible. This means that following the processes around ratification, it's likely that we could see an Australia-UK free trade agreement in place by mid-2022. As a side note, we do continue to see a high degree of underutilisation of free trade agreements by importers in Australia, often simply because there's no certificate of origin accompany the shipment or no robust process in place to ensure there's certificates of origin. But I'll cover off on this in more detail in a few minutes. Next slide, please. I'd also like to speak about Australia's Authorised Economic Operator, or AEO program, the Australian Trusted Trader program. So this program is open to importers, exporters and others involved in the supply chain, such as freight forwarders or customs brokers. As of March, there are 790 members, 22 offered accreditation and 229 progressing towards accreditation. Unfortunately, with COVID, the process has slowed down somewhat, as there is a requirement for an on-site verification meeting as part of the application process, but this now is starting to move again, and you can clearly see by the numbers that there's a very good uptake of the program with a significant number of entities joining. And over time, the benefits to members has increased. So what are some of the main benefits? One of the more attractive, relatively new benefits is the ability to defer the payment of customs duty until the 21st of the month following the month of importation. So, for up to 62 days. This benefit now not only covers customs duty, but also other import taxes and charges, such as the import processing fee. There are also other benefits, such as the ability to waive the need for a certificate of origin under certain free trade agreements, meaning that a free trade agreement can be claimed without a certificate of origin, provided some other form of evidence that the rules of origin are met are available. Now, that's available under certain free trade agreements, not all that Australia is a party to. And benefits continue to be added to the program. So I would just say, if you're not a member as yet, we recommend that you consider what benefits may be obtained by your business from being an Australian trusted trader, and consider undertaking a cost-benefit analysis as a first step before assessing readiness to join and then going through the application process. Next slide, please. So that brings us to the third polling question of the day. The question is, has your business undertaken a customs review in Australia in the last year? So the options we have are: yes, a review was undertaken by a party independent to our customs broker. Yes, the review was undertaken by our customs broker. Yes, a review was done internally. Or no, we're planning to do so but have not yet. No, we've not undertaken a review and have no immediate plans to do so, or not applicable. So,
David, I was quite surprised to hear how many businesses are actually in the Trusted Trader program already, or otherwise seeking membership. So do you have a feel for why the uptake has been so strong?
Yeah, well, even though membership is voluntary, I think that many businesses see it almost as an obligation as a good corporate citizen to be a member of a program, that's ultimately about supply chain security. Also, many multinationals are members of similar programs in other countries and can leverage that as part of their application process to become an Australian trusted trader.
Right, okay.
So we have some of the results in. It seems that the majority there have not undertaken a review of their imports into Australia, where they are an importer, but then have no immediate plans to do so. And then also some have had a review undertaken internally, which is actually quite relevant for what I'm planning to just talk about next, which is around what opportunities are there if you undertake a customs duty review in Australia. So quite relevant to those 36.5% there that said that they haven't undertaken a review, or others that haven't yet undertaken a review as well. So next slide, please. So customs duty is typically not separately reported in financial statements, meaning there is often minimal awareness of the cost of customs duty to an importer's business. Now, businesses usually outsource their import or customs function to a customs broker, and typically have limited oversight or control over declarations made to customs. In fact, customs reviews and from customs audits, they actually release figures around the error rates that they see. And in FY20, customs released information that stated that the error rate is around 27% of all import declarations contain at least one error. So, very, very high error rate. When you consider that the general rate of customs duty is 5%, and there are complex rules around free trade agreements, as we mentioned before, and also tariff concession orders, which is another mechanism to reduce duty. We find that these concessions are often not explored, reviewed, or contested. And these concessions give the ability to move the duty rate down to zero. The reason why that's important is, unlike most other countries in the region, in Australia, there is a 4-year window to go back and claim a refund of overpaid customs duty. So we can look back at any imports that have occurred in the last 4 years, and if there was a concession there that wasn't claimed at the time of import, we can go back and make that claim and get that customs duty back from the government. In fact, in FY20, the Australian Border Force paid customs duty refunds of approximately 260 million Australian dollars. So around $5 million of refunds are paid every week. So I would say that seeking a refund is a common process, and it's certainly not something that creates risk. Importantly, the identification and claiming of these opportunities requires more than simply filtering spreadsheets. So Deloitte has developed a proprietary data analytics offering, which we call Customs Radar, which analyses import data and provides insight, identifies risks and opportunities, and does that from data obtained from the government. We realise that this almost goes without saying, but we'd always recommend that the original customs broker is not the party to effectively review their own work. We do see this happening a lot more than you'd expect. Next slide, please. So how does a customs review work? So with an importer's authority, a download of import data for the last 4 years can be obtained directly from Customs or the Australian Border Force. This data can then be tested for inconsistencies that may conceal opportunities for refunds. To do the initial opportunity analysis, no data is required from the importer. If there are opportunities, documents are obviously required for the purpose of verification and claiming of refunds. To conclude on the customs review point, I'd say that if your business has not reviewed your imports into Australia, you are likely missing out on claiming some of the $5 million per week in refunds that are being paid by customs, such as undertaking a review is likely and could well be a very worthwhile project. Next slide, please. So the final point I'd like to cover is around customs duty management. So rather than just relying on refunds, as I mentioned earlier, importers should be proactively managing their customs duty position in order to minimise the customs duty costs to their business or project. Now, this is because there are a number of benefits that can only be claimed if you are proactive. So I've listed some of those benefits on the slide there, but to speak to a few of them, knowing the customs duty that applies before you place an order. For example, if the rate is lower on goods from one country as opposed to goods from another, this should be taken into account when making sourcing decisions. It sounds simple, but it doesn't always seem to occur. Also, there's an opportunity to apply for new tariff concession orders and other concessions. Now, these need to be submitted before the goods themselves are imported. So applying for a concession post-importation or trying to get a refund if there's no concession that's been applied for just won't happen. So these concessions need to be applied for before goods are imported, and they're applied for basically where you can demonstrate that no one in Australia manufactures substitutable goods in the ordinary course of business is the test for putting that application in. Now, they can be applied for regardless of what the origin of the goods are, so they can come from any country. So we would highly recommend proactively managing customs duty on any upcoming capital-intensive projects and for any large importers, not only into Australia, but obviously it's an issue globally. So in our experience working on large projects, having customs specialists assist with formulating and implementing a customs duty structure upfront will lead to significant customs duty savings through the life of the project. So that concludes the updates I wanted to cover from a customs perspective, which brings us to the end of our discussion today. So we now have some time to respond and talk about some of the questions that we've had come in whilst we've been speaking. So I think the first one here is for you, Nicholas, around besides land and buildings, are there any other items that usually incurred stamp duty in acquiring an Australian company or business?
Thanks, David. So when acquiring an Australian company or business, typically you'll be subject to duty on land and buildings, as well as chattels, which are movable goods. If it's an entity purchase, typically you need $1 to $2 million worth of land before property, plant and equipment are brought to duty, and each state and territory has different rules. Direct acquisition of a business is also subject to stamp duty, but only in 3 of the states and territories. That's Queensland, Northern Territory and Western Australia. In those states and territories, the purchase of a business will be subject to duty on the goodwill, intellectual property, customer contracts, trading stock and trade debts owed by Queensland residents. So there's quite a lot of different regimes there. Typically speaking, anyone who's buying either land or building or business in Australia would need to get stamp duty advice as part of your tax advice on purchase.
Okay.
Thanks, David.
Great. Thanks, Nicholas. Frank, I think we have one here on GST. Would you always recommend having an indirect tax sharing agreement for a GST group in Australia?
Thanks, David. So not necessarily always. So if you have a group of entities and there's no intention that any of those entities will ever be sold in the future, it's probably not necessary to have an ITSA in place. If there is any possibility that any of those entities may be sold, we'd recommend having an ITSA in place in case that occurs. The reason for that is the ITSA, it's not retrospective, so once you set the agreement up, it applies on a go-forward basis. So if you want it to cover all open tax periods, it's best to have it in place when the group's first set up.
Okay, thanks, Frank. Another one for you, Nicholas, is: have you seen many buyers interested in moving to the new property tax regime?
Yes, David, we have in fact seen a lot of buyers very interested in moving across. As I said before, it's mostly the private equity space where they are very interested in it, as well as private individuals for the purchase of residential property. Land developers as well too are quite interested. They have to make a decision though, because once they choose to opt in, they have to sell under the same regime. So it'll be a question of whether a property developer will want to choose to opt in, given what their target audience is expected to want in terms of the purchase.
Okay, thanks, Nicholas. There is one here for me. I'll ask myself, I suppose. So does claiming customs duty refunds in Australia increase the likelihood that an importer will be audited? I'd say no, it doesn't. So when you lodge a refund claim, customs will review a small portion of the claim lodged and only release those funds after you provide the documentation to them, but the majority of the refund is paid as soon as the claim is lodged. There's no connection between the lodgement of refunds claims and which companies might be selected to be audited. And as you could see by the numbers in terms of how much is actually claimed in terms of refund, it's a very common process. So there's no real concern there about claiming a refund would increase my risk of audit. That's just not the way it works in Australia, at least. Okay, so I think that's we've gone through the questions there. So I'd like to say to Frank and Nicholas, thank you, and special thanks to all of you who are able to join us today. We'd like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the Share This icon or have them visit the Debrief's website. We will respond to all the questions submitted during the webcast in a couple of weeks as well in writing. Also, if you can think of any other questions or comments later, please feel free to reach out either to me or our speakers. We'd be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Indirect Tax series on the 20th of May, titled Recent Developments in the Malaysia Sales Tax and Services Tax. So finally, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.